Hey, let's bring on Dan. Dan, this is guys. This is Dan Walters. Dan is one of our students from Boise, Idaho. And Dan, you and I talked about this the other day. It is it's an interesting market in Idaho, is it not?
It sure is. Yeah.
One of those highest growth areas in the U.S., dude. Who would have thought it?
Yeah, who would have thought this was our little secret here for a little bit, but that secret's been out for a while now. And I mean, and Eddie, as you can probably attest, and being in Texas, all the influx coming in from some Western states you have Texas and Idaho seem to be the destinations to go. So it's been a wild ride and continues to be. So
that's what they call Austin, Texas, is Little California, and I think that's what they call Boise, Idaho now, right?
Yep, exactly.
So,
it is.
Just a quick background. So Dan and I have some mutual friends, and I participated in a mastermind that Dan is in. I've done some training for them on a number of occasions for the last few years. This is one of these high volume real estate investor masterminds. And Dan has done coaching, so he's helped other people do the business, and he's a very active investor himself. So what I want you guys to hear today is you can start this whether you have a significant background in real estate or you don't have a significant background in real estate. What Dan would tell you is what we're teaching is like, it's not like all these high volume guys have this figured out, do they, Dan?
No, not at all. No, actually, there's a very small percentage that are just starting to figure it out.
So we talk about the idea of somebody coming in like a NoteSchool trained person and helping these high volume guys because there's such a shortage of people that know how to do it. So, Dan, we're going to throw up a case study today of an asset that you bought. You told us the other day you have 4 terms deals working right now.
Yeah. So it was for as hot as the market's been, it's been a little challenging to step in with some sellers that want to sell for a full retail price, but they know they can get it pretty quick. So when we're bringing terms to the table, it's just it's a long play. It's a conversation we've got to continue to have, and 2020 was not ideal for that. However, we were always continuing to present that and study it, and then I think it's just been the activity and the opportunities to continue to offer that, and all of a sudden it's just kind of hit it. So it's just been the activity behind it.
Well, here's how I say it. If you can buy property and get the seller to carry terms for you in the hottest real estate market in the country, it shows you the power of it works when things are good, and it works for things, obviously, for a market to come that may not be so good. Yeah. And we're not calling all markets the same, and we're not saying everything's going to have the exact same effect, but we do know that that terms are why I originally started this idea a couple of years ago. It was a way to disguise the price because you're buying it on discounted terms and not a discounted price. So, Joe, pull your PowerPoint up. We are
ready to go, man. It is we are ready and got the case study up here and ready to go, man.
Dan, can you see that?
I can. Yep.
All right. So just kind of go down through it with us, if you will.
Yeah. Just real quick background on this. This seller had actually owned this property for 30 plus years. He's kind of right in the middle of a super highly growth area, a high growing area, fast growing area. He's on an acre of land here. So it's just a really highly desired piece of property. But he had a set amount in mind that he wanted. He had multiple conversations over the last year or 2 years with people coming in and with developers wanting to come in and develop it. But he knew he had a set price in mind that he needed to get to make his transition, pay off some debts, all that kind of stuff. And the developers weren't even coming close to what he needed. So he was just been sitting on it. So
Dan, let me ask you, so the current market value is the 515, and let's show the before and after. There's the before on top and the after on the bottom.
Correct.
Beautiful place. And Dan, this thing is
extensive rehab on this, right, Dan?
What's that?
You did an extensive rehab on this.
Yeah, it was 30 years of deferred maintenance and a lot of DIY stuff. So that's
Yeah. So Dan, so the as-is value on this, this is kind of I'm gonna kind of run through these 3 points here, and then I'll kick it back to you. But you said the as-is value is 310,
and that's prior to at the time.
That was the as-is. Your cash offer, Dan, was 245, which was it too low for? It must have been too low for the seller, right?
Correct.
Okay. So Dan, this is the crazy part. So you come in and your cash offer was 1, and your terms offer is $325,000, which is a little bit over the as-is value as you reported.
Yep, just a tad bit, because that's exactly what the seller needed.
Right.
Yep. So that's the crazy thing, guys. There's two unbelievable things about this set of numbers up there. The as-is value was 310. Dan structured a deal where he could offer more than the as-is value. And it had a big rehab budget in it. I mean, it is a big rehab budget. So, and by the way, that of the 90,000 in rehab, though, you didn't put 90,000 up, did you, Dan?
No, it did not. No, I actually had part of that was funded by our private money that came in and helped us finance that.
Let's talk about that. So Dan, you went out. So your total in this, by the way, you've got 3.25 in the terms offer, and you've got a $90,000. So that's 415, right? So you structured the deal like this. You got a private first, like you said, from one of your private lenders for $281,000.
Yep.
And in the terms on that, they were not so creative, right? I mean, you got a 6.4% loan from a private investor for 30 years at 1756 P&I.
Correct.
Okay.
Joe, let me make a point about that, though. When Dan does that, that's a loan that can be paid off. So if he finds another private investor, private lender that wants to loan him money at 5%, he can move that 6.4% money out and 5% money in on the same deal.
There you go.
Yep.
Yeah.
Now, Dan, here's where you get creative, right?
Yeah.
You've got a seller second for 90. And talk about each of these terms here that we're flashing up on the screen here, kind of as they pop up. So, no payments for the first 12 months, right?
Yeah. So here's the thing. I mean, you had a seller who has been really wanting to sell for the last couple of years, but he knew he had a number. He was set on the number of where he wanted to sell it, and he had talked to many people who couldn't come to that. And so when we finally started having this conversation, there was a sense of joy in this seller's eyes, and the hope that finally somebody's going to come through for us. And I think once he was able to realize that we could obtain this for him, because he was retiring and moving out of state, he was willing to, he was happy to accommodate in some of these other terms, because finally there was somebody that could solve his problem. So yeah, he was willing. Like I said, he needed a certain amount of money to pay off some debts, and then it also would help him transition to this new acquisition, to his new home he was going to out of state. So he told me what that number exactly was, and so that associated our down payment, and then he was willing to carry the difference on that, and that tickled him to death. So we knew that we were going to have some extensive rehab. So I just let him know that, hey, look, we're going to be in some time with this thing. So if you can give us a little bit of cushion here before our payments start. I wonder if you can give us, at least a year to be able to kind of get this house where we need it to be, and then we can turn around and it makes money for us, and also at the same time it makes money for you.
So Eddie, you and Dan talked just a minute about this crazy thing that's step rate. What's a step rate, guys?
Well, this is a concept that the more of these deals we cut up, we started figuring this out, that people would agree to an extraordinarily low rate or no rate to start the loan, and down the road, then to get them to carry it, they wanted more interest. But the smart thing that Dan did here is, by carrying at such a low rate, he is accelerating the principal payoff of the loan, right, Dan?
Yeah.
It's a lot. So all of a sudden people think, well, 4% interest isn't a bargain, but for 5 years, really 6 years, because the first year was nothing. For 5 years, he is sawing off the additional principal at an accelerated rate, which means he's paying 4% interest, but 4% interest on what? Less principal. less money. So the math is really good. Another clever thing that Dan, you now do just as an automatic is you set up annual payments, right?
Yeah, and that was something that through the education and just being a part of on some of these calls with you guys, realizing that, hey, we give these annual payments and really separate the note carrier, the seller, from their payments over a period of time. They realize that, hey, that money isn't coming in every single month like clockwork. It's just one lump sum. And as we know, most people don't, when they get their money, the majority of people, they burn it pretty quick. And so they're always looking for more money later. So that's
your play down the road is you're pretty sure he'll call you wanting to sell that, wanting a payoff of his note at less than the full principal amount owed. You'll buy your own note at a discount.
Yeah, and that's what we're anticipating. I mean, he's on a fixed income, so we know that at some point in time that phone call is going to come.
Yeah.
So guys, now we've bought it. We've papered up our buy. Let's talk about, Dan, how you sold this to a penalty box buyer. And guys, remember, a penalty box buyer is just somebody that's missed, right? They've got a good down payment. They're strong. Maybe they're self-employed. Maybe they're a gig worker, whatever it looks like. They're just missed. And they're really part of that 35% of folks that could get a loan back in January of last year that starting in March of last year, they just couldn't. So let's talk about the sale, right? So you've got a total of $415 in this thing, right? So you sell it for $515.
Correct.
Strong down payment, $45,000.
Yep.
Okay. So we've got a $45,000 down payment. We've got a $470,000 wrap lien on the loan. So we got $470 at 5.75. And you're doing this for 30 years, 360 months. So you've created yourself some cash now, and we'll talk about that a little bit more in a second. And then you've got a monthly payment of $27.42 coming into your little bank, right? Your Dan's National Bank for the next 30 years.
Correct.
I just have to laugh. I mean, that's some crazy numbers, right?
It is crazy. And the thing of it is when, with being on enough of these case studies and these calls and just watching, call after call, case study after case study, was going, okay, I know this works, but the question is, is there going to be somebody out there that's going to have that amount down? Is there going to be somebody that's going to be able to make that monthly payment, that's going to be able to truly qualify for it? And the fact of the matter is, once we started advertising it, I mean, they come out like the woodwork. And there's what we found. There's plenty, like you said, the penalty box buyer. There's plenty of people that do have that cash in reserves. They're business owners. They just don't fit in the box that the traditional lending criteria just don't allow. And it was amazing to see the amount of people that really came out and really just solidified everything. I mean, because it wasn't so much for me. It was more of the higher price point, because we were kind of pushing the limits here, I think, a little bit on this particular one. I mean, if we felt comfortable at like a $200, $150, $250, $300,000, but to get up to that $515, it was kind of question like, how's that going to work? But man, it was.
And I'm going to make a point about that. People tell me, well, seller financing works on little cheap houses, right?
Right.
125,000 or less, and it works in San Antonio and out in the country, but nobody would buy a $500,000 house with seller financing. But here's the reality, Dan. Let's look at where the market is, and if a home buyer today, if there was 1,000 people that could qualify for a conventional mortgage last February, 1,000 people, today there's 650 of those people that can qualify, and 350 of them that no longer can get a mortgage.
That's right.
Right. So there's a big market gap. No, we agree real estate's on fire. There's a shortage of listings, but there is also a shortage of financing. Just people aren't talking about it as much.
Yeah. And the other thing that we're seeing too is we have there's a lot more people that are starting businesses. I mean, especially with the things that have gone on this year, people have, they've had an opportunity to step off into do their own thing on the side. And so they've realized that, hey, they're having success, and then maybe they're able to step away from the job in the last year and a half, 2 years. Or 3 years, whatever it is, and their financials aren't super strong, or they're not a W-2 employee. So banks just kind of go, well, sorry, but they've got solid tax returns. They've got great reserves. They've got great P&L, and and their credit's solid. It's a no-brainer.
Yeah. Yeah.
All right, guys. Well, let's
it's
talk
exciting
about.
to see it. Go ahead, Joe. Let's look at the cash flow here.
Let's look at the cash flow. So here's the total income on this thing, guys.
So after you sold it, you ended up with $45,000 profit in your pocket, right, Dan?
Correct.
And then this thing, after you pay, you have 2 mortgages you have to pay every year, right?
Right.
You have the private first and the seller second.
Correct.
And then you're receiving a bigger payment. So you have a wrap mortgage. You're receiving a payment with an obligation of making 2 payments.
Correct.
But you're netting like $8,300 a year, $8,200 a year. I'm sorry, $8,200 a year net income after you pay those mortgages.
Yes. Yeah.
For a long time.
Yeah, that's awesome.
Yeah, the National Bank of Dan is doing well, and guys, I mean that's almost a mic drop, right? So you took something that you could have flipped it and made a little money, but again,
and just to drive this point home, like I have a rental portfolio as well. That's net income that we're talking about right here. That's not gross income. So on my rentals, I see the gross income come in, and I got to take about 45% out for taxes, insurance, maintenance, for all that kind of stuff. When this comes in, it's just straight bottom line.
And guys, I want to point one other thing out to you real quick here that we've got a link on there for the Moneyball book, right? So that is the Eddie's book. It's called Moneyball 2: Creative Real Estate Financing: The Cure for Thriving during post COVID-19. So there's a link there. This specifically is what we're talking about today is in chapters 3 and 4 of that book. So make sure that you download that when you get a minute and read it. And we're going to finish up the book next week on next week's episode, by the way.
Yeah, there's a lot of different strategies, and people think that seller financing the seller has to carry all of his equity. And in this case, the seller walked away with a lot of cash because, Dan, you went and found a private lender.
Yep.
That loaned you the money. That essentially that money went partly for the rehab and mainly to the seller, right?
Yep.
And then all of a sudden you were in a good position with him because he didn't have to wait for all of his money. He had to just wait for part of his money.
Right.
And I believe, particularly in really competitive markets, I think this is a seriously underused strategy. And that's why I wrote about it in that book. Is I'm like, guys, this is a deal that in other words, the house needed $90,000 in repairs. What was he going to do when he called a realtor, right?
Yeah.
The realtor couldn't solve the problem.
Right. Yep. Absolutely.
So, all right. So, Dan, I just want to know, I want to kind of unwind this right here at the end. What do you know now that you did not know a year and a half ago?
Well, let's see. Well, biggest thing, stepping into NoteSchool, it opened up the possibilities of where the traditional cash offer model from a wholesaling standpoint and everything else is, if we can't get it, 65 or 70%, whatever it is, then it's just not a deal. Here, every lead that comes in is a potential opportunity. Because in the traditional wholesale business model, it's maybe 1 in 20, 1 in 30 leads turn into a deal. Here, every lead that comes in is a potential for, if it's not for the cash offer stand, if it's not the cash offer realm, there's all of those can have a potential to fall under the terms realm. So there's excitement when a lead comes in because every single one of those could be a possibility to convert.
That's absolutely right. Your field of vision, it goes from this to this.
Yeah,
exactly. Dan, you're awesome, dude.
Appreciate
Stick around. We're going to have an after party for a few minutes after, so hang in there with us, and Brian's going to take us out here today.
Appreciate you guys. Thank you.
Yep.